we'll account for some bonds issued at face value. We'll figure out how to pay the interest and do all kinds of good things. My favorite bonds are 2-year bonds. There's really no such thing as 2-year bonds. They're mostly 10 or 15, 20 years. But the nice thing about a 2-year bond is we can go from beginning to end and see how it works without making a gazillion journal entries. So let's issue this bond. We'll notice that it's $100,000. It has a stated interest rate of 10%, and it pays interest on these, twice a year, semi-annually. So when we issue this bond on 1/1, we would go cash $100,000 because it was issued at face value. That means the proceeds we got are the same amount as we are going to pay back of bond payable when the bond comes due. Okay, at 6:30, what we would do is pay some interest. So at 6:30, we would have interest expense, and we would have checks go out to all of our happy bondholders. How much is that interest expense, we might ask? Well, you take the face value of the bond, okay, face value, times the stated interest rate, and that gives you the total interest due on that bond for the year, okay? But we're paying that $10,000 in 2 payments, so each payment is going to be $5,000. So interest expense on June 30, $5,000, and the cash that goes out is $5,000. Okay. On 12/31, we would do the same journal entry, interest expense and cash, $5,000. And for the next year, we would do the same 2 journal entries. And so I don't really feel the need to write them all out again, but let's do some T accounts of how this bond works. Okay, so what we've done so far. We issued the bond, and so we got the cash of $100,000. We have the liability, our long-term liability of the bond payable, also $100,000. Okay, then, wait a minute. I'm starting to plan ahead a little bit better here. Okay, so then we're going to have to record our interest expense. Okay, so we paid out $5,000 cash on 6/30, and there's our interest expense. And at 12/31, interest expense for 12/31, that's the end of year 1. And then year 2, we go same thing. The books would have been closed here, but I'm just showing you how this works. So over the life of the bond, our interest expense is $20,000. Okay. At the end of the bond, when it's time to pay our bondholders, we would make the journal entry. It would be on 1/1. We would simply reduce our liability and redeem the bond. Okay, so we would pay off all our bondholders at the end of it. So this ends up being your basic cash flows on a bond. Here's the $100,000 to pay back our bondholders and reduce our liability. So that's our basic cash flows, how a bond works, except most of them go a lot longer. The only complicating factor that you run into that might, just change this up a little bit is a lot of times the bonds will pay interest instead of 6/30 and 12/31. They'll pay interest on 7/1 and 1/1. And that means that we have to do a 12/31 accrual of that interest. Okay, when it's 7/1 and 1/1, because you've crossed accounting periods. So if that were the case, this journal entry here would be interest expense, but it would end up being interest payable because we were not going to pay it until January 1st. Okay, so both 12/31 entries would be interest payable, and then on 1/1, each of the 2 years, you would go reduce your interest payable and just pay out the cash. Okay, it may seem silly, but that's how that works. Okay, and that's about what you need to know about issuing bonds at face value.